office real estate has been under pressure for quite some time now. And I'm excited to get into the details of that today, the asset class, talk about the broader macro of the whole situation. Hunter, you and I have been looking at this for a long time, and it's interesting. It's on the top of a lot of investors' minds, a lot of consumers too. I mean, these days you're walking through downtown, see a lot of empty skyscrapers, not so many lights on, during the day or at night. And so let's get through that a little bit.
Yeah. So starting with the big problem is that, office real estate across the board has really been under pressure since COVID. So according to MSCI, built these office buildings in kind of your traditional financial, or not even financial, but just traditional business hubs, like San Francisco, DC, Boston, are down 52% in value. These, good office buildings in great locations are down over half their value, just in, recent years. And so that's posing a lot of problems for these borrowers, these owners who, have these office buildings that either aren't producing income like they need to, or even worse, aren't producing enough income to, pay that debt. So this is mainly a problem in those like district centers, those city centers. And so, suburb office space has seen a little more resiliency. That's only down in the teens, which is still a big drop for office, something that's traditionally fairly stable. But, it's a lot less of an issue when you're a little bit further from town. You have some more amenities around you. It's kind of a, generally easier place to live and work.
Yeah, I think that's been the interesting thing about the office space trend. And we're going to get into, how we got to where we're at right now, but is that kind of move from city centers into more regional locations. Workers no longer want to fight the commute to get downtown. They don't see the value in some of these city centers anymore. A lot of times, part of that's the, amenities that are downtown are not quite as substantial as, hey, I want somewhere that's a little bit close to where I live, that has more regional, attractiveness, makes that life a lot better. And we're going to get into the, what caused this problem in a minute. But yeah, just to hammer home the point, between 2019 and 2023, or end of 23, we've lost about $557 billion in the real estate market, and as far as value in that office real estate market. Now vacancy rates are hovering around the 20% mark. You kind of listed some of those metrics off, but that's ticked up really considerably. Those are essentially right at near all-time highs for office vacancies. So we haven't seen this kind of fundamental issue with office real estate ever before in the history of the US economy. And that's shifted a lot from 2019. You had office vacancies somewhere in the kind of mid-teens range. So, all the way up, slightly above 20% is really substantial. And I think it creates a lot of problems for the office market. And that's, something that I want to get into over the course of this episode. But, first let's talk about the dynamics. How do we get here? Office seems like such this cool, sexy thing. You see a big skyscraper and you're like, wow, that's amazing. The people that built that probably made so much money. The people who own it probably worth so much. Well, that's not necessarily the case after especially COVID. So why don't we get into that?
Yeah. So like you mentioned, COVID really kicked this off. The shift to work from home for those who could, which traditionally is office workers. We didn't see the same thing in like warehousing, or actually warehousing was a big beneficiary of COVID because people were at home ordering goods. That kind of real estate, did really well. And so it's, an interesting thing where it's not just like the real estate market, it's the components are acting so differently right now. But, with the office real estate itself, is COVID kicked that off of work from home, and people invested so much time, money, and energy in figuring out how best to work from home. How do we make this efficient? How do we make it collaborative? And people just really got used to that in a large measure, working from home, getting their job done, and not facing their 30-minute, hour-long commute potentially each way, every single day. I know I appreciated at least having a hybrid schedule for a while because I was facing a 30, 45 minute drive each direction in traffic. And, when you can do your same job at home, people generally like that. And so, that's still ingrained in people because it is convenient. It is nice. It allows them to take care of family things, during down periods, or if they take a break from work, they can address things. There are a lot of conveniencies that people aren't willing to give up immediately. And so, but coming out of COVID, this was really, the second factor involved is the high interest rates. So coming out of COVID, we started raising interest rates, and that really put a double crunch onto the office sector, because not only are vacancies up, but now so are your rents, because most of these loans on office buildings are variable rate. So rates go up. Okay, office buildings have to pay more. Yes, rental rates increased as we saw inflation. Rental rates were, a big part of that. But that's not going to recapture all the money you lose if your building's empty. That doesn't get you anywhere. So now your rent payment's higher than ever, and your actual receipts are lower.
Yeah, and the way that investors typically look at, commercial real estate and office being included in that is as a yielding asset. They're not always looking for, huge growth coming from owning a portion of an office building or, an industrial warehouse or something like that. What you're looking for is the value of the asset to kind of keep pace with inflation, and then the cash flows from the tenants, from the leases, paying you those monthly or quarterly dividends. And so people look at office space and commercial real estate more as these kind of passive yield assets like a bond. Well, we all know that, when interest rates rise, the value of bonds goes down. And so the same thing happens substantially with real estate. As those interest rates rose, you had the value of those assets decrease. So you're already dealing with a market where vacancies are low. The value of those assets isn't as high because the cash flow isn't as substantial when they're not filled out, right? And so whenever you get the increase in interest rates, it brings that down even more. So you've had some serious pressure on those office assets over the last 4 or 5 years. And I think the dynamic that's creating for broader asset categories is really interesting. So a big part of that is the debt market. I just mentioned bonds. Well, when someone builds an office building or even owns one, they don't want to hold necessarily, all of that cash. They don't want to have to put up all the capital for that. So what they do is they structure commercial real estate or office buildings into debt securities called commercial mortgage-backed securities, CMBS. People might be familiar with traditional MBS, which are backed by home residential mortgages, while commercial MBS, CMBS are just backed by commercial real estate instead. So those are paying you, dividends just like a bond, but it's backed by the collateral of those commercial real estate assets. Well, the problem is that those commercial real estate assets all of a sudden aren't generating the yields that they were previously. And so you've got a problem when it comes to paying out individuals who own the CMBS. Well, and then we had the interest rate dynamic as well. So all of a sudden those CMBS are worth less because they act exactly like a bond. And so they go down in value. Well, something that's also very unique to the office space is what's called a SASB loan, single asset, single borrower. So that's essentially like a commercial mortgage-backed security, but it's based on a single asset. So you've got single asset risk. Well, because of that, it's going to yield a little bit higher. But the problem is whenever you're making this loan on, say, it's a Manhattan office building, and you think that, hey, this is a wonderful Class A office space. No, none of these tenants are ever going to go anywhere. It's in a prime location. Well, boom, COVID hits. And when this debt was shopped out to people, they say, hey, okay, well, no one's leaving this office building. It's in prime location. It's perfect. It gets rated AAA by credit rating agencies. And that's essentially the same or better than US Treasuries, which are considered risk-free. So you get into a situation where you've got what was called AAA debt is now being defaulted on because these office buildings, they don't have the lease cash flow generation, and they can't pay out the investors at the end of the day.
And the incredible part about that is that AAA bonds are structured and, defined as such based on the expectation of default every 5,000 years. So you're talking about once in every 5,000 years is the standard to which we're assigning these office buildings.
On AAA, right.
On AAA. And so now we have a quarter of those SASB loans that you mentioned had their credit rating dropped. And so that creates all sorts of issues with for alternative managers as well as office real estate REITs. And you're expecting, one every 5,000 years. Well, you're not expecting a quarter of your portfolio to, over the course of a couple of years, either be in some sort of default, in trouble, or get their credit rating dropped. And so this has created a whole lot of implications for the investment industry. Victor, I'll leave it to you to walk us through some more of those, but namely those office real estate REITs as well as alternative managers are really the first two that come to mind.
Yeah, they're holding a lot of that, whether it's the debt or the equity in those. So the office REITs, typically owning equity in those office buildings. And we've seen those just get pummeled over the last few years. And it's a shame for those managers, because it's like everybody else. Who could have seen COVID coming, and you wouldn't have expected that, but that's the situation that they're in. And like we said, unfortunately, the market is not recovering quite as fast as we'd liked. We'll get back to kind of the, work from home dynamics and such. But the other piece of that, another stakeholder in that situation, are banks, and especially regional banks. Well, we saw, in 2022, the regional bank blow up early in the year as rates started lifting off. Well, part of that was because they have so much money lent to commercial real estate. They're the big bulk of commercial real estate lenders. And just as we just went over, whenever those cash flows aren't coming in, whenever those buildings can't pay, at the end of the day, if they have to default on that debt, that means that asset is going to the bank, and sometimes they're not even able to sell it for what they lent out the money for. So if you think about your typical home mortgage, you probably pay 20% down or something close to that. That's an 80% loan to value. Well, they're lending out even less than that on a percentage basis to these commercial properties. But the value of those is getting marked down sometimes 50, 60%. And now some of these banks are underwater on these properties, which they don't want to have to be going to markets to sell in the first place.
No, banks notoriously don't want to take your assets. They're not in the market of selling your house, of selling a yacht, of selling an office building, especially in tough times. And so that's not their business model. They don't want to do it, but it's, forcing them to, because at some point, if you stop paying, then this is all the recourse we have. Take a loss on it and hopefully move on. But that is creating a lot of headaches for them. And so part of that, I want to look at what can people do? What are they trying to do to creatively problem solve for this? And the biggest thing I've heard time and time again are office to multifamily conversions. So you're talking about taking an office building and converting into some sort of multifamily apartment, condos, sometimes a hotel. And that can work in very specific cases, but there is a fundamental problem with how office buildings are constructed and the architecture behind them, because you're usually talking about, for example, one or two centrally located bathrooms. Well, apartments, you're going to want, generally at least one bathroom in each unit. And so that creates a whole lot of, this plumbing is running through walls, through floors, not easy to retrofit. You're talking about a lack of exterior windows. So all of your interior rooms, well, office buildings are built as big squares most of the time. Squares are rectangles. And if you'll notice, a lot of apartment complexes take some sort of like U shape or horseshoe, or, have a central area where they can get more window coverage so you don't feel like you're trapped in a box. And so, there are design issues like that people are trying to solve for with mixed levels of success. But the big hiccup to that is the expense that it takes to retrofit an office building. And yes, while they're selling at 50, 60% discounts right now, a lot of estimates would require another 50 or more percent in order to make it a profitable business venture to convert any of these. And so the silver lining in this is that state and local governments are also stakeholders in this. They don't want their downtowns to be full of empty office buildings, lifeless. There's a lot of economic opportunity that you lose when people aren't walking around and, hopping in a coffee shop. They're just driving straight to work, drinking the coffee there and then going home. A lot less economic activity from that. And just, the general appearance of having a lively downtown. There's a lot of desire to maintain that. So you are seeing a lot of initiatives from state and local governments to try and help offset some of these issues and clear those hurdles to get those converted. But, that'll be something really interesting to keep an eye on as it progresses, because, there's a lot of desire to do it, but the economics don't always line up with that.
Definitely. And then I guess you have the other option of tearing down a building, potentially starting from scratch. But that's typically going to have to turn into either multifamily, like you said, or some kind of mixed use real estate. I think it's interesting, the trend towards mixed use and multifunctional space when it comes to office buildings. I remember talking when I was living in Houston to a lot of real estate developers, and the trend really was towards the multifunctional mixed space where you've got some kind of combination in a complex of office, multifamily with apartments or condos. Your ground floor is retail or restaurants or a combination of both, just increasing that attractiveness so that whenever you're booking a lease for that office space, you can tell those individuals, hey, you've got, access to restaurants, retail, there's places to live right here. So it becomes a lot more attractive for those looking to lease up that office space. And then I guess if you're talking about solutions, the work from home trend is starting to go under pressure. A lot of companies, we've seen Starbucks, a lot of others, Amazon, a lot of companies pushing their employees to get back in the office, because it's not so much that you can't be productive at home, even though there is probably something to be said for having oversight over your employees' activity. But it's, building that culture that's really been missing outside of COVID, because how much can you really commune with other people when you're talking about doing that over Zoom call? It's not like you can chat in a room with 5 or 6 people and everybody be talking at the same time. It just doesn't work that way. So I think there is that big shift from work from home to at least be in the office 2 days a week, 3 days a week. More and more commonly, we're seeing people go back to 100% say, hey, you're back in the office 5 days a week. And so maybe something like that will help save the office conundrum that we're in.
Yeah, definitely something to keep an eye on as I return to office, because we've had, like you mentioned, Starbucks, Amazon. I know Meta or Facebook did something similar. Dell, you have a whole slew of them are either more days in office or all days in office. So that's certainly going to help the sector, as well as it looks like, based on the numbers we're looking at. You said a little over 20% vacancy rate. That's very little changed from last quarter, was right at 20. So you're talking 20% to 20.1. So people are, some people are speculating maybe we found a top to the vacancies or a bottom to the occupancy rate. But so time will tell, but there are some, positive factors there. And then on top of that, we still have a really strong labor market. And that's something that makes this unique situation from previous, is that we have a strong labor market, yet office is really under pressure, which is, a new conundrum. But as long as that stays resilient and some of these return to office plans continue, I think the space could see some strength going forward.
That is a good sign, is that this wasn't driven by a general downturn in the economy. We've had a very resilient economy. It doesn't look like we're going to hit recession. All the economic data coming out, which we'll continue to talk about on further episodes, has looked really good. And so I don't anticipate some kind of structural shift where all of a sudden offices aren't filled because the economy's bad and there are just no jobs. It's going to be because of these factors. And I think that kind of leads us into what we're looking at as far as the investment piece goes. I think staying higher quality as far as office space, like we mentioned earlier, there's a lot of demand for those more regional offices. So if you're looking at office REITs or some kind of office real estate fund, it's going to be that newer Class A mixed use, more regional type that has those low vacancy rates, high occupancy. If it's cash flowing right now, then it's probably looking good, for the foreseeable future.
Yeah, I think that's a great point, is that if in these market conditions, in this market environment, it can still provide that solid continual NOI, high occupancy rates, then, knock on wood, each office is its own unique thing, but in general, that should be a very good indication.
Yeah, and I think just looking at real estate broadly, it feels like we've kind of bottomed in the space. If you look at the trend of asset values, they've essentially been marked down to the point where they probably should be following this rate rise, which has impacted the broader real estate market outside of office. But it seems like asset prices have bottomed and are starting to tick up again. And so you're probably at a good space in the cycle as long as you're sticking to quality. I mean, personally, we're still kind of staying away from office space just because that environment is really tough right now. It's hard to project what the work from home shift is going to be and what worker preferences look like. But as far as broader real estate, I think it looks like asset prices have mostly bottomed. And like I said, the economy is looking good. So it's not a bad time to get into some of those, higher quality assets.
Yeah, and I think that's a good point too, is we're very much a pick and choose market. You can't just buy broad exposure. I've, know some alternatives managers who are really excited about office right now, actually, because there are opportunities out there. If you know what to look for, you spend a lot of time due diligencing these things and really, have good, top down whole process information and lots of research into that. I think it's really hard for people to come in from the outside if you're not intimately familiar with this space and, realistically with proper risk controls drive a good return here. So, it depends, but I know, I think that's something to call out, is that there are a decent number of alternatives managers who are really excited about it right now.
Right. I think real estate's always going to be an interesting asset class. It's always going to be core to investing as far as, being a unique asset that has, a lot of the qualities that we like to look for as far as, cash flow generation, yield opportunity. And so it's going to have a place in portfolios, and it's going to be really interesting to see how office space and broader commercial real estate tracks over the next few years.
Yeah, certainly a lot to keep our eyes on, and we'll provide updates as we get them.
Absolutely.